Before we jump into Kabbage and Keep, I really want to jump into the concept of idea selection. A lot of us, including myself, would be really lucky to come up with an idea that we feel such a strong conviction for that we would leave our day jobs and go start something from 0 to 1 or 0 to exit like you've done. How do you go about assessing if an idea is good enough or not to sort of take full time?
I think I have this bias towards ideas that involve technology solving a problem that hasn't been contemplated in that way before. Even starting Kabbage, providing working capital to small businesses, the idea of it was not because one of us was like trying to get a line of credit for a small business. It was that eBay had launched a really interesting API that allowed third parties to get access to seller and transaction level data. And my co-founder, Rob, was like, that's interesting. I wonder if we could use that to make a loan to an eBay seller. And that's how Kabbage was born. So the idea was not so much, obviously, Cash has a really good product market fit. So that was an easy decision to make. But it was more about, can you do something unique and interesting with technology?
Mm. So I'm just reading Elad Gil's High Growth Handbook. And he had an interview with Mark Andreessen about sort of the two moats that you can build. One is a product and technology moat, and the other is a distribution moat. Well, first of all, I guess tell us a little bit more about Kabbage and the origin story, and like how did it grow as well as it did?
Well, we joked that we were in the world's second oldest profession. So it was, it's really easy to give people money. It's really hard to get it back. Small business is really hard to find. And we didn't know this at the time, but we wound up serving, and I say this, I talk about this all the time. There are 30 to 33 million small businesses in the US. All but 6 million of them have no employees. Of the remaining 6 million, 90% have fewer than 20 employees, 80% have fewer than 10. It's the long tail, but they're really hard to serve because they're so small. And we wound up, because we started with real-time access to third-party verified data, we were able to grow this business relatively rapidly because we could build a risk model. When you think about a moat for Kabbage, the real moat was time, because we started so much earlier than everybody else. And there were other companies sort of in adjacent spaces, but we didn't say, oh, we're going to build a better on deck. Oh, we're going to build a better cam. We're going to build a thing that serves this market, and then we'll grow it from there. But because we were automated, we were able to grow and scale and serve a really hard to serve market. And I think that's what got us that mode of time and also distribution, because we were able to accelerate the brand and messaging, and people knew who we were and they trusted us.
That's really fascinating. When did you think you reached product market fit? Like what was that moment?
It was literally the first person who borrowed $1 from us because we didn't have to worry about product market fit. Just because all small businesses need access to capital. It's the number one reason that businesses go out of business is lack of access to capital. Mm.
So access to capital is a good transition. I think Kabbage raised on Crunchbase $2.5 billion between venture and debt facilities. Can you talk about like what that journey looked like? This was in the early days in Atlanta. How did that, what was that experience like, and how did that change?
If there are any Atlanta-based investors in the room, my apologies for what I'm about to say. But we joke that you need to make Delta your silent partner because you got to get out of town to raise money. But this is in 2008, so I'm sure things are totally different now. But we had to leave town. We really tried hard. We talked to all the investors here, and we just couldn't get anywhere. Our first term sheet came from a West Coast, well, not our first term sheet. Our Series A term sheet came from a West Coast investor. And we wound up, most of the money we raised came from all over the world, but almost none of it from Atlanta, even though we created, 600 jobs here. Jeez,
that's amazing. We were just talking back there about how the investment landscape has changed now than it did, what it looked like back then, right? So 2021 is a crazy year. You actually just fundraised at Keep, so congratulations.
Thanks.
How would you say it's different now than back then? Has Atlanta changed?
Atlanta's changed a lot.
Awesome.
There are a lot more people who are interested in, especially seed stage, because that's where you really need the funds. And just to be fair to Atlanta, our seed round was about $2 million, and this was in 2009. And I would say about a quarter of that came from friends and family based in Atlanta. It wasn't from, institutional investors, but it was from people in Atlanta. So that was nice. Just shout out to Atlanta. But we knew we wanted to build a company here anyway. And I think the difference is there's a lot more funding. We're in a place, we're sitting here right now, that was started by a couple of folks who wanted to get back to Atlanta and wanted to help small businesses, and startups grow. So I think that's exciting. I still think for larger checks, you got to get out of Atlanta. There's just not that much here. But what's exciting about it is that you're not convincing people that Atlanta is an okay place. I mean, the number of times we were meeting with investors and they were like, why are you guys based in Atlanta? And we said, because we live here. I mean, why else? And we also had to explain why Atlanta is so great, which I love this city. And I love the diversity. I love the city itself. I love the culture that's here. I love how beautiful it is. I like the weather. I mean, there's so many great things about Atlanta, and we have a lot of tech talent, especially in payments. So I educated, I feel like, the world about why Atlanta is a great place to be.
I think it's such a fascinating topic because there's this concept of industry towns, right? When you reach sort of a critical mass of employees, innovators, investors, potential customers, people sort of gravitate to those areas, right? So Detroit for automotive, Silicon Valley after Transistors and Fairchild. If I wanted to go start a career in movies, I'd go to Hollywood. What sort of advantages and disadvantages have you seen over the period of building companies here?
Well, if you're in payments, obviously it's harder to find. It's harder to find better talent anywhere else. The disadvantage is that so many of the companies, especially in payments, that are here are really large corporations that are slow and bureaucratic, and they don't necessarily attract the kind of employee that a startup wants to have. So we were really lucky because when we started Kabbage, it was sort of early on in the tech trajectory. So we had a great advantage hiring tech folks to come to us because they wanted to work in a place that felt a little more West Coast, which we didn't read the Google handbook and say, oh, we're going to have a ping pong table. We just wanted to build a culture that was a place where we wanted to hang out. I like to have a glass of wine in the afternoon. So we had kegs or whatever. So that was, and then other people brought their own, unique spin to the culture. And I think that was fun, for folks who wanted to work in a different environment. But I think Atlanta has a lot of sort of old school tech folks, but we're attracting newer people. And Georgia Tech is a great way to get that talent into Atlanta. And I think it's been it's been amazing for Atlanta to have that stream of graduates coming into the system.
Totally agree. Let's talk about maybe some of the mistakes that you think you've made over building Kabbage and how you think you're going to change those while building Keep. How
much time do you have?
Plenty.
Oh, man. You didn't tell me you were going to ask me this question. I would have prioritized them. I think the hardest, gosh, when I think about Kabbage and the mistakes, you know what? The biggest thing I wish that we had done differently is we were always trying out new things. Where could we take this business? Where could we take the market? How do we expand internationally? And we decided that we would expand with big bank partnerships. So we had these huge relationships with Santander and ING and these, multi-trillion-dollar banks, and they sucked. Because and I think this is a message for tech companies in general when you have a David and Goliath situation. And what happened is we couldn't control the narrative. We couldn't control growth. We couldn't control, the product as well when we had these really big partnerships. And so they didn't work. And it's fine. We learned from it and we shut it down. What I wish we would have done earlier, though, is build out the rest of the products that small businesses needed. And so it wasn't until after we, sort of made that mistake, I guess, that we refocused our efforts in the US and said, we really need to figure out what are all the suite of cash management products that small businesses need that they don't have access to in one place. So I think that's the biggest thing we would have done differently. And I think the other thing is just the number of people we hired. We really tried hard to keep it small. And it was still 600 people. And it was just too many. I sat in this meeting. I sat in 3 meetings in a row. I'm not even kidding, to talk about what color the payment card was going to be we were going to ship our customers. And I was like, I don't care. Just make a decision. Just ship it out. And if it sucks, we'll just ship some other cards out. But the amount of time that we're spending getting to this decision is insane. And so, and when we reduced our staff, we were able to get to much faster decision making. And it was at the beginning of the pandemic. That was a really hard thing. We let go half our staff because we really thought, and maybe this is a question you're going to ask me about the pandemic, but we really thought we might go to 0. we were terrified. We're like, dude, we're serving small businesses and they're probably all going to go out of business. I mean, who knew what was going to happen? We were terrified. So we cut half our staff, like immediately shifted the business into this PPP thing, which was also nuts. And but we did it really, really quickly, and it was great because the teams were focused. We had direct communication with everybody, and in 3 weeks, our engineering team built a PPP machine that was automated. It was unbelievable. I mean, I get chills when I think about that time. But I think hiring so many people so quickly really stood between us and some more rapid growth we could have achieved in the market and with our customers with the product.
I mean, as a product person, I think I could dig into that comment for the next half hour. But I guess that leads me to another question, which is like, it's really easy to get high velocity and shipping a lot of products when you're in the same room and all your engineers in the same room. And then COVID changed that. And then I think people have gotten really comfortable with having remote work. And so how are you building Keep differently than Kabbage?
One thing I will say about the team at Kabbage is that the engineering team especially, they've been begging us for a decade. Can we please work from home? And we're like, come to the office. And finally we relented and we went to, you could work from home 1 day a week. And then the pandemic hit and the team did such unbelievable work. I was like, okay, I was wrong. Y'all can work from wherever you want to. I don't really care. But the difference, I think, between that, this was like this unbelievable moment in time, and we were like fighting to save the company. And I think that engendered some behavior and work that might not have occurred if it was just a day-to-day work from home situation. And if you switch to Keep, we have 8 employees in 3 different cities. And it stinks for me. I hate it because that we're not all in the same place. Because I really need to be around people, and I love that sort of the collision conversations and the ideas that happen when you run into somebody, at the water cooler or whatever. I just think that's really valuable. It doesn't have to be every day, but when you have 8 people in 3 cities, it's really hard to replicate that via Slack, via Zoom, via email, whatever the communication vehicle that you use. But we're figuring it out, and I'm going to date myself, but the younger people, they really seem to think that's cool. They're fine with it. They're like, yeah, we'll do Slack all day. We don't need to go to an office. We think that's, a waste of time. And if it works, that's fine. It's just, for me, it's just emotionally less satisfying.
Yeah. I think in the last session, I want to go back to sort of the mistakes and metrics. Last session, we heard a little bit about how some VCs are going from pre-product to pre-revenue to now you got to show revenue. What was it like when you were fundraising for Kabbage? And some mistakes do kill companies. So how did what were some of the metrics that you had to keep up with? And how difficult was it to raise when you sort of made that mistake and had to go pivot?
Well, we originally, and again, we started in late 2008, but we didn't raise money until late 2009. We didn't get a customer on our books until the middle of 2010. That's sort of the trajectory for that. But we did our Series A in 2009. No. Is that right? 2010. Anyway, whatever. That's the time-ish frame. So I think, sorry, I had to do math, and then I'm an English major, so I lost my train of thought. Tell me the beginning of the question again.
Product metrics.
Oh, sorry. Got it. So in 2013, we had a bunch of customers, and we were really focusing on loss rates, how many people weren't paying us back. And it may come as a surprise to you that a portfolio of eBay sellers is not the most stable portfolio. So a bunch of them didn't pay us back. And in 2013, we're like, holy shit, we got, teen level in the teens delinquency, and that's no good. And we were going to need to raise some more money. So we tightened everything. We, reduced our staff by 20%, all the things that you might expect that people would need to do. And we realized that we had a story to tell, that we had actually, without knowing it, had built a bit of a moat. And what that was R&D. We realized this is a population of customers that we can't serve, and we cut out the bottom 10% of the customer base, which represented 80% of the dollars. And we were able to go out and tell a story and say, hey, we have all this knowledge now and information that we didn't have before, and nobody else has this. We're the only ones that have it, and we parlayed that into our next round. So that was really a great experience for us, because we realized that the metrics we really needed to be following were a little bit different. We switched to sort of a an LTV to CAC ratio because we realized that, and at that time, SaaS was all the rage, not that it isn't now. So we realized, however, that we had a really good story to tell there, and that our customers stayed with us for a really long time, and we generated a lot of revenue from them. And so that was sort of where we fell. But we actually built this app that we used internally so that we could track at any point in time how many customers were coming on board, how much were they borrowing, what were repayment rates, who was delinquent, and in what bucket were they delinquent, and we were able to in real time constantly look at where that was. And Rob, my co-founder, was totally obsessed with this all the time, and he'd be like, "Wait a minute. On the fourth Tuesday of a month at 4 p.m., we've usually done blah, 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 and now we've only done X, Y, Z." And the engineering team would be like, "Oh, shit, Rob thinks something is wrong," and it usually was. So it was really a great tool to figure out, like, are we really, is something broken? Like, is everything working the way we expect it to?
That's amazing. So I think all of our wishes and dreams is the liquidity event. It sounds like a lot of things went right for Kabbage. How did you make the decision to sell or get bought by American Express? What did that look like? What did the process look like?
Well, we've been talking to American Express for years about all kinds of things. Should we work together? Should you buy us? Whatever. And that never panned out. And then enter the pandemic. And in March of 2020, we're like, well, we're going out of business anyway, so let's call American Express. And we had a bunch of friends there, and we started talking, and they were like, yeah, we think we should be interested. And what really changed the conversation was the PPP program, because we generated so much revenue from that we really didn't need to sell. We didn't need to raise money. And then American Express suddenly got even more interested because now they were sort of competing with our own success, and they kind of realized that they really wanted this deal. And we're like, I don't know if we want this deal. And so it was nice to be, I would say, more evenly matched in that conversation than we were when we started. And that's probably what precipitated it. And it took a really long time. We sold this company without any humans meeting each other in person because it was the first year of the pandemic. It was really nuts to me that transaction happened, all that diligence occurred, and no one shook anybody's hand. I was like, are y'all even sure we're here? I mean, I don't know. I was kind of flabbergasted by it.
That's amazing. So yeah, I mean, maybe this is a good time to pivot to Keep. Did not do an intro to Kathryn. I apologize. Co-founder of Kabbage, co-founder of Drum, co-founder of Keep now. Just raised money from Andreessen Horowitz. What did that experience look like? How's that different than your prior lives?
Andreessen did not invest in Kabbage like 400 times. That's how many times we asked them for money. We always wanted to get money from Andreessen just because they talked about what a great infrastructure they have to support entrepreneurs. And we're like, that's really cool. We'd love to engage in that. But they never invested. One phone call after selling a company to American Express, and they're like, oh, how much do you want? I was like, wow, that's really unbelievable. So it was a totally different experience. And we didn't even talk to a bunch of other people because we didn't need to. So, and it's true, they really have this unbelievable machine to help their portfolio companies, whether it's recruiting, like we have a meeting every week with an internal recruiter who just hires people for us. And that we only have 8 people, but it's nuts, the things that they do for their portfolio companies. So that's been really neat, and it allows you to focus on other stuff. And at Kabbage, we spent so much time raising money. It was such a distraction. Now we're it almost makes us tinker too much because we don't have to spend all of our time on that. We can, worry about go to market and worry about like whether this is green or blue or, it's a totally different experience.
I actually love your previous comment too, which is a lot of founders are like, I need money to keep going and building, but they don't actually think about all the other value propositions that an investor could bring. Can you talk about some of the best moments you've had with some of your investors and your board and like the value that they brought besides the money? Because I think recruiting is a really good one.
It is, but we haven't had anybody at Kabbage. We never had anybody, I think, help that much. SoftBank Capital led our Series D, and then the Vision Fund did our Series F, and that's a different experience that I'm happy to share a little bit about. Hopefully, none of them are listening to me. But before then, I would say it was just money. I mean, people who understood our space and they were supportive, but mostly it was just money because you can't expect that much. I mean, your investors and your board members, they don't wake up every day saying, oh, what can I do for Kathryn today? They've got other things to do. So I think entrepreneurs expect too much from board members and investors. They expect too much affirmation. They expect too much support. They expect too much because it's important to you. For you, that's the only investor you have. And you're like, this is a big deal. And for them, they're like, well, I got 17 other portfolio companies. It's not as big of a deal to me. So I think that's different. SoftBank, the Vision Capital, our board member was so amazing. He helped us all the time. He was always making introductions, and he was, bringing the board along with things that we wanted to do. It was really great. Now, the Vision Fund was different. We had a couple of meetings with Masa, and basically every time he was like, more, do more, spend more money. You should be putting out billions of dollars a year. And we're like, well, do you want us to get any of it back? Because we can do that, but that seems like a bad idea. And the idea behind the Vision Fund was they would bring together all these great portfolio companies, and they would all work together to create this like operating system for, dramatic growth. But it didn't really play out that way because, again, every one of these companies is worried about themselves. It's really hard when startups work with startups, or even, high growth companies work with high growth companies, because their interests aren't aligned. Everybody's working on their own stuff.
Yeah. Maybe the opposite, which is, and last question. Have you ever had board members that were just super invasive for any reason? Like they just wanted to be involved all the time? Maybe no names.
We had a board member, we had an investor that was basically so disruptive, so frustrating, so annoying that I think that's basically why we sold the company. So I say this only because it's really important that you like your board members, because you're kind of getting married to them.
Yep.
Your investors and your board members. And it was just a terrible, terrible, terrible relationship. And if we could go back in time and change something, that would also be something we would change immediately, because we would not have taken their money, because it was just so bad. But mostly, and they were very intrusive. They were like always digging in, like, hey, can't you charge your customers more? They were kind of private equity-ish. So don't do that either. But they, no offense to private equity folks in the room, but anyway, they were always like, can't you make 15 more cents per customer doing this? And we're like, listen, if we do things that help our customers grow, then we're naturally going to succeed. You shouldn't suggest that we do things that are going to hurt our customers, because that's going to hurt our business long term.
Yeah.
But they just didn't have that vision. They just didn't think about things that way.
That's fantastic. I think we're out of time. Questions?
That's the best one, but I'm going to add to speaking to another portfolio company. Speak to a portfolio company where things didn't go well, where they had a bumpy time, where the company went out of business, where things like that happen, because that'll help you understand how your board members and investors behave when things aren't going so well. To me, that's the biggest trick. And I have a friend who's running a company right now who has a very, very inexperienced board member who is freaking out every time everything happens, and it's a real distraction to her business, because this person doesn't know how to like be patient and and invest in the CEO and not freak out over every little thing. To me, that's the number one thing that you can do.
When you guys approached Amex for the deal, were you guys considering other players in the payment space, other card networks specifically, or even payments processors themselves? Given that they do have a lot of this transactional data themselves, they could probably help underwrite some of the loans that would go into these small businesses. And as a distribution channel, it kind of makes a lot of sense, considering that Visa kind of has Amex has their own closed network and kind of deal with a more limited number of merchants in that sense.
We did. We knew the MX folks, and we were also trying to get PPP done at the same time. So we hired a banker, and they shopped us to other folks in those same categories. We had a really unique issue, which was we were a balance sheet lender. And it's really hard for the payment networks, non-American Express, or the platforms like the big, banking infrastructure platforms. It's hard for them to have a balance sheet business. Even American Express didn't keep the portfolios that we had originated. They created a totally separate company to run those, because they just wanted the people in the tech. They didn't want that legacy business.
How does an English major become a founder of a payments company?
Kabbage was like my seventh startup. I've always been involved in technology. My parents got me a computer when I was 9, in 1979, a Radio Shack TRS-80. And I always thought technology was really interesting. I never wrote code or anything, but I was in graduate school planning to become an English professor. And I was like, this really sucks. I don't think I'm going to spend my whole life doing this. And I wound up coincidentally getting involved with this data compression company that was a lot. This is in 1995. It was like Pied Piper, if you watch Silicon Valley. It literally was that same company, but way too early. And so I was like, this is way better. I'm just going to do this now. But I think communication skills are really important. And so the fact that I can, read and write and communicate effectively and succinctly has been super valuable. It was shitty. So the first one was even worse, just because I didn't have experience with it before. We had 100 people. We let go almost 20%. And it was amazing though, because we had hired a bunch of middle manager kinds of people, and work wasn't happening as quickly. And after that, and you also, I firmly believe every company can afford to eliminate 10% of their staff, because you just don't, and not everybody is performing, not everybody is contributing. And I think there's a lot of good. And every time we did it, both times we did it, people were like, oh my God, why did you wait so long to let this person go? So I think that was the first time. The second time was just, it was such a scary time, because it was the beginning of the pandemic. We thought we were going to have to let everybody go. We did this decision just to save as many jobs as we possibly could, and have as little of an impact as we could on those people. And we had to do it over Zoom. So it was just awful. But we just did the best we could to give people as long of runway as we could to extend their options exercise. What was great about what we did there was all the people who were part of the layoff were able to participate in the transaction. So they all were able to keep their equity, and everybody made money on that. And so that was, I think, one of the silver linings of the whole thing. And we were over time able to hire some of those folks back. But it's stressful, and it stinks, and you cry, and I don't know. It's really hard. How do we think about giving out equity to the team? We gave everyone equity from the very beginning, including we had about 100 people in Bangalore. Those folks had equity, that was really a struggle to set up. Customer service, people who just came out of high school, we had equity in the company. It's funny, part of that is the reason we started our new company, Keep, because we realized that people who are with us for a really long time probably didn't get leveled up on equity the way they might have if they changed jobs. And there's nothing more expensive than loyalty. So maybe they would have been better off if they'd received cash compensation earlier, if we had the cash, because they could have done something with it themselves. They could have invested it. They could have, created a nest egg, paid off student debt. We had a number of employees who couldn't even participate in the 401k matching program because they were busy paying off student debt. So this idea of flexible compensation, I think, is important. What I wish we had been able to do is give people a choice. How do you want to be paid? We pay everybody the same way, but everyone's in a different position. And so I think I would do we are doing things differently now.
Let's say co-founder relationship probably kills a lot of startups.
Really? No, I'm serious. Is that, you think that's true?
Yeah, probably one of the main reasons why startups fail.
Co-founder relationships, one of the main reasons the startups fail. My word, his words, not mine.
I'm curious. There probably was some conflict resolution mechanism that you went from, especially turning that over to business venture. What were those kind of scissors or to stop when you guys were at odds with each other's decisions? I think that's very common.
So how do we resolve conflict? And it's interesting, when we started, there were three of us. Our third co-founder was Mark Gorland. He went on to found a company called Rody, which sold to UPS last year as well. So I think a lot of it, when we had three, we had this question from our Series B lead, and they said, how do you handle that with three people? And we're like, I think the way it works is good decisions get made quickly and bad decisions don't happen because of the three of us talking. And we did not have a lot of conflict. Even with Rob and I think early on, the biggest fight we ever had was our first tech hire, because we didn't know how to hire this person. We didn't know what to look for. We had some friends who we had talked to people. It was let's see, pray. And so I wanted to hire this super weirdo dude, and he wanted to hire this super uptight wearing a tie guy. And we wound up hiring the weirdo dude. And I think the only reason the company succeeded in many ways is because this guy was such a nut job that he worked super hard and he built the whole platform all by himself in about 6 months. And I think that was really an unbelievable asset for us. And I'm not saying I was right about it. I'm just saying that we fought about it and ultimately came to the same decision. But like, it was kind of a knockdown drag out. And then after that, we're like, that sucked. Like, let's not have those discussions anymore. And I think we wound up just being more calm and patient and, listening to the other person a little bit more before, getting uptight. And I think we just got much better at that over the years. There's always conflict, but ultimately when you have employees and you've taken investor dollars, you have to figure out how to get past it, because you can't let something like that tank your company, and you can't let that tank your employees that have, made an important life decision to come work with you.
Even though you said it was a mistake to go and work with those larger banks, can you talk a bit more on being like a really early stage startup, but needing or wanting to do partnerships with large established players? Like, how do you broach that conversation? It's literally just an email like, hey, we want to talk to you guys. Like, how do you get high up in those organizations to actually have meaningful dialogue with people who can make decisions?
Well, I think we're experiencing that with Keep right now more than we do with Kabbage. With Kabbage, we're really fortunate because what happened is these CEOs of these big banks called us up. They're like, hey, we want to do a fintech thing. Can you do that with us? And we're like, yeah, we'll figure something out. So that was different. They came to us. I think you have to leverage your network, leverage your investors. Like for now, for example, for prospecting for Keep, we're actually asking all the investors that we've known forever, as well as those who would like to invest in the future, to help. Introduce us to your portfolio companies, introduce us to the CEOs We're in a little bit of a different position now because we're old and we know a lot of people, so we can get to more senior leaders. But I really think anytime you can get to a CEO, a COO, a CFO, one of those folks, you have a better opportunity, a better chance for people to pay attention to you down the line, so to speak, when you're talking about a large organization. I know it's hard, banks especially, dude. I hope that your company doesn't need to work with banks because God help you. The TLM process, which is the third-party lifecycle management, I learned all this from American Express. That process takes you like 3 years at American Express. It's really hard. And it makes it hard for them to work with startups because they can't do new stuff as quickly because it takes them so long to onboard. If you don't have like your SOC 2 and blah, 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 the things that they want, then they can't work with you. And if you're a startup, you usually don't have that. So I would get as high up as you possibly can in the organization and hope that you get a referral. And then also, like I said, leverage the investor network that you have as much as possible. And just go on LinkedIn and figure out who's connected to those people and buy them a beer or something.
So we're actually going to cut this off, break for lunch, but please grab some of us while we exit. So thank you.